Welcome to The Explainer, where we break down the key signals you really need to know. And this week, man, the markets have taken a beating. So the big question on everyone's mind is, what's coming next?
All right, here's what we've got on top for you. First, we're going to take the market's temperature. Then we'll follow the money, see what the big guys are doing. After that, we need to talk about the political mess, check the economy's pulse, and finally, I'll give you the key events you need to circle on your calendar.
So first things first, how are the markets really doing? Now, you might see a few green days here and there, but don't let that fool you. Underneath the surface, there is some serious weakness, especially in the crypto market, which has just taken a huge hit. Yeah, and to really get a handle on just how serious this is, we've got to use the official term, bear market. Look, this isn't just some little dip, okay? We're talking a technical drop of 20% or more from the recent highs. And history tells us these things can be a quick, painful shock, or they can drag on for what feels like an eternity. So this brings us to the million-dollar question, right? The one every investor is asking. Have we hit the bottom? Are we about to see a massive rebound? Or is there more pain ahead? And honestly, nobody agrees. Analysts are all over the map. Some are calling for a recovery. Others see another leg down. And some think we're just stuck in a choppy sideways market for a while. Okay, so with all this confusion, where do you even look for clues? Well, one of the best strategies, as always, is to just follow the big money. So let's take a peek behind the curtain and see what the institutional players are doing right now.
And one of the clearest signals we're getting is coming from the futures market. We're seeing what's called institutional open interest starting to drop. Now just think of that as the total number of bets the big players have on the table. When you see that number shrinking, it's a pretty strong sign that the big fish are cashing in their chips and stepping away from the table. They're dialing back the risk.
And it's not just in the futures market either. If you look at what corporations are doing, that crazy, aggressive Bitcoin buying spree we saw from company treasuries, yeah, that's pretty much slammed on the brakes this quarter. For now, at least, the shopping spree is over. But let's keep things in perspective. Even with this slowdown, the top 100 corporations in this space are still sitting on a massive pile of Bitcoin. We're talking over 1 million. So they've stopped buying as much, sure, but they haven't started a panic sell-off. Not yet. But here's where it gets a little more nuanced. Even with that slowdown, if you look at the most recent activity, there are still 9 companies buying for every 1 company that's selling. So what's the real takeaway here? The pace of buying has definitely hit the brakes, but the big players aren't running for the exits in a panic. They're being cautious, absolutely, but they're not panicking. Now, all this caution in the market isn't happening in a vacuum, you know? You have to look at the wider political landscape, which right now is creating some major headwinds for investors. A key factor you've got to watch is the increasing political infighting. We're seeing some serious cracks forming within the Republican Party over Donald Trump's policy ideas, and that kind of conflict adds a thick layer of unpredictability that markets absolutely hate. And you can really see this shift in public opinion. It's pretty striking. A recent poll from Fox News, a traditionally friendly outlet for Trump, shows that a stunning 62% of people now believe he's causing more harm than good to the economy. That's compared to just 32% for Biden. That is a dramatic reversal. So why is this so important? Well, this isn't just about political polls. It's about market confidence. When households, who, by the way, own a huge percentage of the stock market, start to feel like government actions could destabilize everything, the natural impulse is to de-risk and, well, sell. And on top of all that, we have a huge wild card. We are all waiting on pins and needles for a Supreme Court ruling on those Trump-era tariffs. A decision could drop at any moment, and it has the potential to inject some major volatility right back into the market. So, you've got this political uncertainty happening, and at the same time, we're seeing some very clear caution flags coming from the U.S. economy, and it's really all coming down to the American consumer. There's this really stark contrast right now. On one side, consumer sentiment is just in the gutter. People haven't felt this bad about their personal finances since 2009, and the fear of losing a job is at a 5-year high. So all this anxiety is about to get tested by a whole bunch of hard economic data this week. And that first big test is the retail sales report. The consensus forecast is for a clear slowdown, with growth expected to drop to 0.4%. Now, this could be the first concrete sign that consumer spending, which is the main engine of the U.S. economy, is finally starting to lose some steam.
So, with all that in mind, what are the absolute must-watch events? Let's quickly summarize the key data points for this holiday-shortened week ahead in the US.
All right, here's your checklist for the week. Tuesday's retail sales report is critical. That's going to tell us a lot about the consumer. Then on Wednesday, we get the Fed's Beige Book, which gives us a real on-the-ground look at the economy. And of course, we'll be watching producer prices, durable goods orders, and those weekly jobless claims to get the full picture. If you found this video helpful, be sure to smash that like button and subscribe so you don't miss your next Daily Edge. More news in our Telegram channel in the first comment. See you next time.